Hey everyone, welcome back to Corporate Decoder. Today, Bleichroeder Acquisition Corp, the third, just filed its S-1 registration statement for its initial public offering, and I'm seeing a critical detail about how this SPAC plans to find its acquisition target. Quick note, this is not financial advice. Just my take on public filings for educational purposes. This SPAC is brand new, so we're looking at the blueprint for how they plan to operate, and there is a fascinating section on how their management team hopes to find the right business to merge with. So let's break down what this filing means for potential investors. Bleichroeder Acquisition Corp. Third is a special purpose acquisition company, or SPAC. Think of it as a company with no real business operations yet formed solely to raise money through an IPO and then use that money to buy another company. They have about 24 months from the IPO to find a suitable business to acquire. If they don't find one, they have to return the money to investors. The management team here is quite experienced with individuals who have held top executive positions at major companies like Sprint, Altus, and Alcatel. Lucent, they also have experience with other SPACs like Bleichroeder Acquisition Corp. and Bleichroeder Acquisition Corp. The which is good to see. Their strategy is to focus on North American and European businesses in what they call disruptive growth sectors, basically companies being transformed by technology. They believe their network and expertise will help them find and improve these businesses. Now, what is really interesting is their investment criteria. They are looking for companies that operate in disruptive growth industries, have strong management teams, offer opportunities for add-on acquisitions, and would benefit from their team's experience to improve operations and market position. They want businesses with a defensible market position, a unique product offering, strong growth prospects, attractive margins, and companies that are fundamentally sound, but perhaps underperforming their potential. This detailed list tells us they are not just looking for anything. They have a specific idea of what makes a good target. Let's talk about who is behind this SPAC. Their sponsor is Bleichroeder Sponsor 3, LLC Michelle Combs, and Andrew Gundlach, who are also listed as co-founders and executives, are the managing members of this sponsor. They hold significant control over the sponsor's decisions regarding the company's shares. There is also an investor called Inflection Point Fund ILP that is looking to indirectly buy about 5 million private placement warrants through the sponsor. This setup means the sponsor and its managing members have a strong incentive to get a deal done. Now here is a key point about dilution. The sponsor purchased founder shares for a tiny amount, about $0.002 per share. This is super cheap compared to the $10 per unit offering price for public investors. This means that if the company merges with a target business, the sponsor's stake could be worth a lot more than what they paid. Even if the stock price isn't super high, the filing highlights that this nominal price paid for founder shares can lead to significant dilution for public shareholders. If the company completes a business combination, the sponsor is likely to make a substantial profit even if the stock price declines. This is a common feature with SPACs and something investors need to be aware of. Looking at the capitalization table before the offering, the sponsor held 11.5 million Class B ordinary shares. After the offering, with the public units and private placement warrants, the structure becomes more complex. The filing mentions that these founder shares will convert into Class A shares at a 1-for-1 basis, but there are anti-dilution provisions. What that means is that if the company issues more shares later, especially in connection with the business combination, the number of Class A shares the founder shares convert into could be adjusted to maintain the sponsor's roughly 25% ownership. This can lead to more dilution for public shareholders. This sentence from the risk factors is crucial for investors. It stresses that the money raised in the IPO is held in a trust account. Public shareholders only get their money back from this trust account under specific conditions, either when a business combination is completed and they choose to redeem their shares, or if the SPAC fails to find a business combination within the specified time frame and liquidates. If you need your money back before one of these events, you'll have to sell your shares on the open market, and there is no guarantee you'll get back what you paid. Looking at the financials, as this is a pre-IPO filing for a SPAC, the numbers are pretty basic. As of the 10th of April, 2026, the company had a net loss of $25,587, which mainly covers formation and general administrative costs. This is typical for a SPAC before it starts operations or finds a target. The total assets are also very minimal at $195,667, composed mainly of prepaid expenses and deferred offering costs. Their liabilities are slightly higher at $196,254, largely due to accrued offering costs and a small promissory note to the sponsor. The shareholders deficit section shows that the only shares issued and outstanding at this point are Class B ordinary shares held by the sponsor, totaling 11.5 million shares. These have a par value of $1,150, and the additional paid in capital is $23,850, resulting in a very small shareholders' deficit of $587. It is important to remember these Class B shares are essentially the founder's stake and will convert to Class shares later. The statement of operations reflects the initial costs of setting up the company. The formation and general administrative costs are $25,587 for this very short period from the 1st of April to the 10th of April, 2026. This means the SPAC is burning through a small amount of cash just to get organized. These costs are covered by the sponsor's initial investment and temporary loans. The company is spending money on deferred offering costs, which are expenses related to the IPO like legal and accounting fees. These costs are $183,314. They are not immediately expensed but will be charged to operations if the IPO doesn't go through. If the IPO is successful, these costs will be accounted for differently, with some allocated to temporary equity and some to the warrants. A notable detail is their status as an exempted Cayman Islands company. This means they have an undertaking from the Cayman Islands government for 30 years that no profits, income, gains, or appreciations will be taxed. This is standard for many offshore entities and SPACs, aiming to simplify tax structures for potential business combinations. However, when it comes to US taxes, it is a different story. The filing warns that US investors might face uncertain tax consequences, especially regarding passive foreign investment company or PFIC rules. If the company is deemed a PFI, taxes and complex reporting requirements for US investors. They mention the possibility of making a qualified electing fund or QF election, but emphasize that this is complex and might not fully avoid the PFI tax implications. Looking at the underwriting section, Cohen & Company Capital Markets is the sole book running manager. They're helping the company sell 30 million units at $10 each, aiming to raise $300 million. There is an over-allotment option for an additional 4.5 million units, which could bring the total raise to $345 million if fully exercised. The underwriters get an upfront commission of $0.6 per unit and deferred commissions that are released only upon a successful business combination. This deferred commission structure is common and aligns the underwriter's incentives with getting a deal done. The total number of units being offered to the public is 30 million, with an additional 4.5 million available if the underwriters exercise their over-allotment option. This means the company is potentially looking to raise up to $345 million before any redemptions. This is a substantial amount and gives them a good starting war chest to find a target. And finally, the risk factors are extensive. As expected for a SPAC, concerns highlighted include the fact that investors have no basis to evaluate their ability to achieve their business objective since they haven't picked a target yet. There is the risk that shareholders might not get to vote on the initial business combination, and even if they do, the sponsor's founder shares will influence the vote. The ability of public shareholders to redeem their shares could make the company unattractive to potential targets, and there is also the risk of dilution from the founder shares and private placement warrants. The nominal price paid by the sponsor for founder shares is specifically called out as a source of significant dilution, and it is clear the sponsor stands to make a substantial profit regardless of the business combination's ultimate success for public shareholders. So, what is my take on Bleichroeder Acquisition Corp, the third's negative one? This SPAC has a management team with significant experience in big deals, which is a plus. Their focus on disruptive growth sectors is strategically sound. However, like any SPAC, the risks are substantial, particularly around dilution from the sponsor's cheap founder shares and the inherent uncertainty of finding and successfully merging with a target within the set time frame. The tax implications for us investors, especially the potential PFI status, are also a considerable red flag to investigate further. The key takeaway for potential investors is to understand the immense dilution risk and the speculative nature of SPACs, especially this early in their life cycle. My biggest concern is the sheer amount of dilution baked into the capital structure due to the sponsor's cheap founder shares, which is a pattern seen in many SPACs and often leads to underperformance post-merger. The research tools I use to track these filings are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this breakdown was useful, please like and subscribe, and check out the Discord in the description.